If your e-commerce brand is processing over 1 million per month, this conversation is different. At that level, payments are no longer software. They are infrastructure. And most 8-figure brands eventually realize something uncomfortable. Running 100% of revenue through a single processor is a strategic liability. Today, I'm going to break down what serious e-commerce operators actually do at scale and why payment diversification becomes non-negotiable once you cross 7 figures monthly. When you're doing 20K or 50K per month, you optimize for convenience. When you're doing 100K per month, you optimize for stability. But at 1M plus per month, you optimize for control and leverage. At that level, a 1% authorization lift equals 6 figures annually. A 0.15% fee improvement equals tens of thousands. A 48-hour outage can cost hundreds of thousands. A reserve increase can distort cash flow planning. This is no longer tactical, it's strategic. The biggest mistake I see at 1M plus per month is processor concentration risk. One MID, one acquirer, one underwriting relationship, one algorithm making decisions about 100% of your revenue. That is not infrastructure. That is dependency. Even if your processor is excellent, no serious 8-figure brand leaves its entire revenue pipeline exposed to a single decision point. Because risk doesn't come from fraud, it comes from volatility, and e-commerce is volatile by nature. At 1M plus monthly, you're dealing with aggressive ad scaling, international expansion, higher AOV bundles, subscription continuity programs, seasonal revenue swings, fulfillment strain during spikes, dispute clustering from growth pushes. From your perspective, that's growth. From a processor's perspective, that's exposure. And exposure management tightens at scale. That's why enterprise operators plan before they scale, not after they get reviewed. Serious e-commerce brands build layered payment architecture. That includes multiple merchant accounts, multiple acquiring banks, traffic routing logic, geo-optimized processing, chargeback forecasting, negotiated reserve structures. Pre-approved processing ceilings, they don't wait for issues, they structure resilience into the system. Because resilience equals valuation stability, and valuation matters at 1M plus monthly. Here's something most operators underestimate. At scale, authorization rate optimization can produce more profit than ad creative improvements. If you're processing $1 per month and improve approval rates by 1%, that's $10,000 in recovered revenue. Every month, multi-acquirer setups allow for smart routing, bin-based routing, geographic optimization, intelligent retry logic. Single processor setups don't give you that flexibility. You lose the ability to optimize. When you operate with multiple acquirers, something powerful happens. You gain leverage. You're no longer negotiating from dependency. You're negotiating from optionality. That affects interchange markup, reserve percentages, settlement timing, rolling reserve duration, risk tolerance. Leverage at 1M plus is strategic, not cosmetic. At 8-figure annual run rates, your job isn't just growth, it's continuity. Payment interruptions impact cash flow, media buying velocity, supplier confidence, investor confidence, team morale. Enterprise e-commerce brands protect continuity first, then optimize if you're processing 1 plus per month, scaling aggressively on paid media, or expanding internationally. Running subscriptions or preparing for Q4, you should not be operating on a single processor model, not because your current provider is bad, but because growth requires architecture. We work with 7- and 8-figure e-commerce brands to design payment infrastructure around their growth, not just replacing processors, designing multi-acquirer strategy, risk distribution, authorization optimization. If you're at or above $1 per month and want to understand your current exposure, we built a simple e-commerce infrastructure assessment. It takes about a minute. It shows whether your payment setup is built for scale or still built for convenience. Link below. Because at this level, infrastructure is strategy. Let's dive deeper into the acquirer layer. Having a direct relationship with multiple acquiring banks gives you a redundant foundation that most brands lack. Each bank has its own risk appetite and geographic strengths. By splitting your volume, you ensure that if one bank tightens its belt, your business doesn't suffocate. This isn't about hiding volume. It's about distributing risk. It's about ensuring your media spend has a clear path to conversion, regardless of individual processor volatility. Chargebacks are inevitable at scale, but when they cluster on a single account, you're at the mercy of their automated flags. Multi-mid setups buffer that impact significantly. Now let's talk about the profit you're leaving on the table. Every declined transaction that should have been approved is a customer you paid for but didn't convert. Intelligent retry logic and routing to the bank, most likely to approve a specific card type, can recover 2% to 5% of revenue instantly. Imagine that hitting your bottom line. For subscription brands, this is the holy grail. Reducing involuntary churn through better payment architecture is the single fastest way to increase LTV and brand valuation. Investors look for stability. A brand that can prove its revenue isn't dependent on a single third-party decision is a brand with a much higher multiple during an exit. You gain the edge in every negotiation. When you have 3 banks vying for your volume, you dictate the terms. Lower reserves, faster settlements, and better rates become the norm. Expanding into the UK or EU, local acquiring is non-negotiable for high approval rates. Our architecture makes that expansion seamless and highly profitable from day one. Continuity planning isn't just about insurance, it's about peace of mind. Knowing that a random algorithm update won't halt your media buying is how elite founders sleep at night. The cost of inaction is invisible until it's catastrophic. Don't wait for the account under review email to start building your payment infrastructure. The time is now. To summarize, 8-figure brands win by building for resilience, optimizing for every basis point, and maintaining leverage through optionality. That's the architecture of scale. Take the first step. Use our e-commerce infrastructure assessment to identify your current blind spots and start building a payment system that matches your growth ambitions. Our team of specialists is here to help you navigate the complexity of multi-acquirer setups and secure your brand's financial future. You don't have to do this alone. Our mission is to give high-growth e-commerce founders the same level of payment sophistication as the world's largest enterprise retailers, because you deserve control. The future of e-commerce payments is decentralized and resilient. Join the ranks of the elite brands that have already made the switch. Build your infrastructure today. Remember, at 1M Plus per month, infrastructure isn't just a cost, it's your most powerful strategic advantage. Don't leave it to chance. Plan for success. Link below to get started. I look forward to helping you secure your brand's legacy. My name is James Hunter, and this has been the 8-Figure Payment Architecture Masterclass.